the way that we're presenting it here on the left-hand side, you can see a circle that essentially is called pre-tax investing. And on the right-hand side, a circle is post-tax. And each one has a unique opportunity. Think of pre-tax investing first, which is any employer that you're not currently located at. You might have had a 401k, a 403b, a 457, or a host of any other acronyms starting with the number 4. And in all of those, you're able to make what are called self-directed accounts. And we've been alluding to these throughout the presentation. But the beauty of this type of investing, which I used in the beginning as we were funding our investments, is that you can take money from your previous employer's 401k, move it into a self-directed IRA or a self-directed 401k, invest it into the real estate property through that entity. And as that money comes back as distributions, it comes right back into your self-directed account. The beauty being you don't have to pay taxes on it at present, and you didn't pay a penalty in order to make that investment. Those are two very important nuggets of information we want you to leave here with. Now, mind you, I'll reiterate a statement that Anne made earlier. We are not tax professionals, nor are we accountants. Please consult your tax professional, your accountant, your employer as to the specific rules of how and where you can utilize that funding. Now let's go to the right-hand side. The right-hand side is where really the goodies lie. If you have cash, savings, money market accounts, IRAs, and in certain instances, Roths, but Roths are a unique situation. And I agree with Anne wholeheartedly. We will have to cover that all in a future webinar to get into the granularity. But let's say I have 100,000 sitting in an IRA or a money market or even in the stock exchange. I can go ahead and take that money and put it into a business bank account, invest it into real estate. And then throughout the term that we talked about, the 3 to 5 to 6 years of holding the investment, you will be able to get a K1 as a distribution listed, but you'll also have depreciation listed for this building. And you'll be able to take potentially that depreciation as a reduction in your taxable income for that year on your W-2. Again, this is just an example of how we've utilized it. It may not be an example of how you're able to utilize it, but think about what I'm saying here. You can use post-tax money to make the investment to get a future return, but along the way, you might be saving some taxes that you have to pay if you're able to claim depreciation against your taxable income. Most people don't know that, and I think it adds to the value of real estate investing.